Glyn, here we are at the start of September, reflecting on an August which had a lot of different nuances really from where we're sitting.
Yes, August was a surprising month in many respects. As we said last month, we thought that the increased volatility we'd seen in markets, that sort of mid-year correction was giving some opportunities. And in the event that was indeed the case, there were some opportunities, but the markets were stronger than we really expected in August, and led incidentally very much by the US. I think it was a key dominant feature of the US equity market. It was up nearly 4% in the month, and for the first time ever breached the 2000 level on the S&P 500. So quite a landmark for the US market. Triple the level of March 2009, the low point in the cycle.
But turning away from the equity markets, government bonds really also provided some pretty strong returns.
Well, yes, I think in many ways government bonds were the dominant feature of markets in August. They've been strong already this year, we've remarked on it several times, but August was a really quite extraordinary month. And unusually, the bond markets are being led by markets in Europe. It's normally the US Treasury market being by far the biggest in the world that leads markets. This time we're seeing European bond markets lead the way, and I think that's because we are seeing the European economy slowing down. The recovery we've seen has been fragile and tentative, but the numbers coming out recently have suggested the economy is slowing down a little bit, and we've seen yields falling, I think, really quite dramatically across Europe. The 10-year yields fell by about 1/4%. It's a big number, bearing in mind that in Germany yields were already only about just over 1%. They've fallen to below 0.9%, and we've got yields right across the spectrum in European government bond markets at the lowest levels for this cycle. The other extraordinary statistic is that during the course of this month, the yield on 2-year government bonds in 9 European countries fell below zero. I mean, a really quite extraordinary situation to find ourselves in. And I think what that has done is caused people to look elsewhere in this sort of search for yield. So Treasuries also did quite well, despite the fact the US economy has been strong. UK gilt market was very strong on the back of what was happening in Europe, and also some actually very benign inflation numbers in the UK. So gilts returned nearly 3.5% in the month. And we've had these big returns right across Europe, about 2% from government bonds, and of course corporate bonds has moved up on the back of that as well. So I think that was arguably the key feature of the month.
Economically, I mean, Europe not painting a particularly pretty picture, but the US still doing quite well. You're seeing a real divergence there now.
We are seeing a real divergence, and I think again that is a feature. The US, we had that weather-induced very weak Q1. That's now history. The Q2 numbers for the economy were revised upwards to 4.2% growth, a big quarter. We expected that big bounce back. But all the forward-looking indicators are suggesting that growth is going to remain around that 3 to 4% level, whether you look at the labour market, which is strong, manufacturing, purchasing managed indices, durable goods, the housing market has bounced back. So generally a positive tone coming out of the US, whereas in Europe we've seen this slowdown. The Q2 growth numbers from Europe, quarter on quarter, were flat. And in the big three economies, Germany, France and Italy, that are big three Eurozone economies, we actually saw a negative quarter-on-quarter annualized growth. There's a little bit of an impact coming in from what's happening in the Ukraine, and we've already seen quite a number of European companies warning about the hit to sales and exports into Russia. Confidence is being hit, but generally we're in this very tough environment in Europe still, only slowly coming out of austerity, and I think we've got some time ahead where the European economy is going to be fairly bumpy. Still recovering, we still believe in that, but fairly bumpy. So yes, definitely divergent performance, and of course that has pushed the dollar quite a bit higher. It was a strong month for the dollar, up nearly 2% against the euro. Sterling fell back 1.5 to 2% in the course of the month, having had a very strong move. And importantly, the yen also fell back a little bit, which I think will help the Japanese market in due course. Japan is actually one of the weaker performers in August.
You mentioned already, but underneath this macro surface, there's still the geopolitical tensions going on as well.
Yes, there is, and it remains quite a worry for markets. there's sort of really three things people are focusing on. The least of the market is concerned is Israel, Gaza, and there appears to be some sort of long-term settlement emerging there, but that's tiny in the overall scheme of things. I think the big one the market's been worried about in the past month is what's happening in the Ukraine. The Ukrainian forces appeared to be regaining ground held by the rebels in the east of the country. Then we've evidently had Russian troops appearing in eastern Ukraine, raising the spectre of sort of an all-out European war. So that's certainly been a concern for markets, and it's definitely a factor impacting on European confidence and sentiment and growth. But as we speak today, very early September, there appears to be some discussions and a real possibility of a sort of a settlement between the Ukraine and Russia. Markets are bouncing quite strongly on that today. It does, though, remain a fluid situation. That there have been sort of talks about settlements before. Nevertheless, we have always held the view that there will be a diplomatic solution to the Ukraine crisis, and I think we will progressively move towards that. The third area of concern, of course, has been the ISIS movement into Iraq. As we expected, that movement has been arrested with with some help from the US, of course, but Kurdish and Iraqi forces at least stabilizing the situation. And there's no risk of ISIS moving into southern Iraq, where the big oil fields are. So interestingly, the oil price, which spiked to $115 a barrel in June when this ISIS movement first happened into Iraq, has fallen all the way back to $100, down about 4% in August. So I think that's telling us quite a lot.
Finally then, let's take what we've seen in terms of the context and apply it then to monetary policy, particularly.
Yes.
Europe meeting tomorrow, in fact.
Well, the ECB is meeting tomorrow, and I think again one of the big features this month on the back of two things. First of all, this evident slowdown in the European economy, very weak inflation numbers. Inflation is running at less than 0.5% in Europe. The ECB is definitely moving towards a further round of easing. Draghi, the president of the ECB, made a speech just a few days ago in the US, Jackson Hole, where he was very dovish. He made it very clear that monetary policy can and should have a key part to play in stimulating demand, and that policy will remain loose for a long time to come. I think there's a real possibility that tomorrow when the ECB meets there will be a further round of easing, which could include, for the first time, quantitative easing in the private sector. They will be buying asset-backed securities. They're moving towards that. If it doesn't happen tomorrow, it's going to happen in the course of the next 2 or 3 months. So there's no question in our minds that the ECB is going to remain with a very, very loose monetary policy for a long time to come. We've said before there's still too much debt across Europe. We've seen this sluggish growth. And I think the ECB is going to be loose for years ahead. I think the Bank of Japan is going to be loose for a long time to come as they're struggling to overcome this setback in the economy from the increased sales tax in April. So they're going to remain very, very dovish. The Fed and the Bank of England, which will be the first banks to tighten policy, I think the market is expecting moves too soon. I think it's going to be well into next year before either the Fed or the Bank of England moves. And these low inflation numbers we're seeing across the world are very supportive of that loose monetary policy, of course. So I still think we've got, generally speaking, a loose monetary policy, and the ECB and the Bank of Japan being very, very loose. So lots of liquidity still available, and this search for yield will go on in this environment.
Overall, then, it's not a bad environment for equity still.
No, it's not a bad environment for equities still. Our concern is that some markets, particularly in the fixed income area, offer pretty poor value. Do you really want to buy government bonds, particularly in Europe now, and Germany yielding less than 1% for 10 years? That doesn't look like an attractive investment. Neither does it in the US, frankly. And of course, most sectors of the bond market are priced off that. So there are pockets of overvaluation, without a shadow of a doubt, in the fixed income markets. But equities, I think, are well supported. We still see economic growth moving ahead at sort of slowish sort of rates, so inflation not being a particular problem, monetary policy remaining loose. So yeah, I think we're going to get through this year with some quite reasonable gains from equity markets, and I think we can look forward to 2015 where we will see further modest gains from equity markets. So yeah, I think a generally supportive environment.
Good. Thanks, Glenn.